This is The Markets. I'm Chris Hussey, and today is Thursday, February 12th, and I'm with Lina Thomas, who is our senior commodities analyst within Goldman Sachs' Global Investment Research Group. Lina, thanks so much for joining us on The Markets.
Thank you so much, Chris.
All right, you're the gold and silver specialist, so let's start with gold if we can. It's up over the last 12 months, 6 months, year to date, everything. Even yesterday on a payrolls report, it still went up 2%. However, last couple of weeks, we did see some volatility. It had a 15% dip. What do you make of gold today and the volatility that's just been reintroduced to it?
Well, we've seen actually an acceleration in the gold rally in 2025, right? And that has to do with the fact that private investors joined central banks in competing for the same limited gold bullion. Now, why did these private investors enter the gold market? Well, two reasons. One, the Fed is cutting, and so the opportunity cost of holding gold is now lower. But two is this so-called debasement trade. So basically, fears or worries around fiscal sustainability in a lot of Western economies. And this debasement risk is basically where the volatility is coming from. Why? Well, one way of expressing this debasement risk is through buying gold call options. And what we've been seeing in 2025 is that gold call options have been steadily building through 2025. And in January, probably on the back of all the headlines that we had in January, that gold call option demand went vertical. Now, the thing with these call options is that as prices go higher, dealers that had sold these call options now have to start buying gold to hedge their positions. So basically, as prices are going higher and higher and higher, dealers are buying more and more and more gold, so the rally starts feeding itself until there's a breaking point. And that was end of January when we had the Warsh Fed announcement, which seemed to ease some of these worries. And we saw that prices start to fall. But now these dealers that had been buying gold to hedge their gold call positions now start to flip into selling into this weakness. We also saw a lot of stop losses being hit, and losses start to cascade through the system.
Just to clarify, is that a call option on the ETF or on gold itself?
We see a lot of call options on the ETFs.
Okay. So technicals on top of technicals, because gold is always kind of driven by technicals to a degree. What is your view now on gold as it sits here today? Can gold trade higher, or are we just caught in the volatility that's not worth the trouble?
So we're still bullish gold. We're expecting gold to go to 5,400 by the end of 2026, but we do see significant upside to that forecast. Let me explain why. Our forecast only takes into account that central banks keep buying at the pace that they have been buying, which is a very reasonable assumption given that EM central banks are still underweight gold, and that private investors will just buy on the back of the Fed cuts that we're expecting. That means that we're not taking into account any further diversification flows into gold, and that source of demand can really create a lot of upside risk to our gold forecast. That being said, a lot of that diversification, as we've been seeing, has been expressed through call options, and that creates more sharper price action, as we've been seeing. So still bullish gold, but we'll probably see more volatility going forward.
Yeah, and of course that diversification can come in other types of assets. Let's turn to one of those, silver, the old second sister of gold. What's going on with silver? Because that, in this volatility move, traded down almost 35%. What's up with the silver?
So silver is actually a story of a liquidity squeeze. So to understand what's going on in silver, we have to go to London. London is the place to be for precious metals. It is where the global benchmark prices are set. Now in silver, you have these vaults all across the city. And in those vaults, about half of the vault is already allocated to someone. It's somebody's silver. It's silver that you cannot touch. The other half is liquidity buffer. Now, what we've been seeing in 2025 is that liquidity buffer in London has been vanishing over time. Why? Well, a lot of traders had moved a lot of that silver that was in London to the US in anticipation of potential tariffs on silver. So we've seen a big dislocation of that silver to the US. Now, At the same time, around mid-2025, what started to happen is that we saw a lot of investor enthusiasm around silver because the Fed is cutting. We have the catch-up trade to gold. We also have this debasement theme that has some spillovers into silver. And so we saw more and more of that investor demand into silver in an environment that has very low liquidity. So every time we see this new wave of investor demand, we're starting to hit the bottom of the vault, and you get this extreme price spikes to the upside, but also to the downside, because every time we do see an investor pull back, that also means that you have a little bit more liquidity again, and so you drop much more sharply. We're not expecting that liquidity to restore anytime soon. So that means that we're expecting this extreme price action in silver to persist a little while longer.
I love that term, bottom of the vault. Gold and silver, they've always been described as stores of value. And I guess what you're telling us is where it is stored can make a difference on the value as well. Okay, let's broaden it out beyond gold and silver, because you have other commodities that have also rallied, like copper. Is the gold rally telling you something about those copper rallies? And are we on the cusp of a commodity supercycle here?
That's a great question. And the thing that is the same, or like what is similar with this, is that the insurance demand that we're seeing in gold, what we've been seeing from central banks buying gold to hedge themselves for geopolitical risk, we're seeing that same insurance spreading in other commodity markets. We're seeing that through, for instance, stockpiling. We're seeing that through tariffs and export controls and state-backed investments. And that can create a bit of a market fragmentation, which can lead to more volatility, as we've, for instance, been seeing in silver. Now, here's where gold is different from the other commodities and why we're not expecting a super cycle where prices will just go higher forever. And that is because gold is different in the other commodities, that gold is something that you cannot pump. It's something that you cannot scale. It's something that the production is just very constrained. That is different in other commodities. When you see this type of stockpiling, supply security policies, that higher prices, that ultimately will incentivize more production coming online, that means that basically these higher prices won't last forever and may actually, sort of like drop on the back of, higher supply coming in.
Ostensibly, gold is rare. Copper, not so rare. All right. You've talked positively about gold. You talked about silver as well. What do you like most, gold or silver?
We have a stronger conviction in gold, simply because this liquidity squeeze that we're seeing in silver is something that creates extreme volatility, extreme price action. And not everybody can stomach that type of volatility. And on top of that, gold has still a structural demand bit from these central banks, typically a little bit more structural demand also from institutional investors looking to buy gold. So we definitely prefer gold over silver.
And for our listeners, as we go ahead throughout 2026, what are the data points you're looking at most closely to gauge gold?
So for gold, we're still looking at the central banks, whether they're still buying. We think that with the high volatility, we probably will see a little bit of less buying, just because the volatility is something that may, dampen sort of like their demand. And we're also definitely watching these call options, which can lead to a very fast rallies and also very sharp pullbacks.
Lina, this was a terrific conversation. Thanks so much for joining us.
Thank you so much.
That does it for this week's episode of The Markets. I'm Chris Hussey. Thanks for listening.
The opinions and views expressed herein are as of the date of publication, subject to change without notice, and may not necessarily reflect the institutional views of Goldman Sachs or its affiliates. The material provided is intended for informational purposes only and does not constitute investment advice, a recommendation from any Goldman Sachs entity to take any particular action, or an offer or solicitation to purchase or sell any securities or financial products. This material may contain forward-looking statements. Past performance is not indicative of future results. Neither Goldman Sachs nor any of its affiliates make any representations or warranties, expressed or implied, as to the accuracy or completeness of the statements or information contained herein, and disclaim any liability whatsoever for reliance on such information for any purpose. Each name of a third-party organization mentioned is the property of the company to which it relates, is used here strictly for informational and identification purposes only, and is not used to imply any ownership or license rights between any such company and Goldman Sachs. A transcript is provided for convenience and may differ from the original video or audio content. Goldman Sachs is not responsible for any errors in the transcript. This material should not be copied, distributed, published, or reproduced in whole or in part, or disclosed by any recipient to any other person without the express written consent of Goldman Sachs. Copyright 2026 Goldman Sachs. All rights reserved.